So I think one of the key things to talk about first is just to remember that valuation is not the only deal term in a deal. So it's the most obvious one that people sort of see, and it feels like it's the price that impacts everything. For a long time, maybe it was the only thing you cared about because we had an era where all the terms were generally, at least at seed and Series A, all the terms were generally pretty vanilla and they were pretty entrepreneur friendly, meaning they weren't that onerous. They maybe a little weighted more towards the entrepreneur than they were to the investor, although not maybe back to the Facebook era where founders were getting these 10 times the number of shares with founder shares and had super voting shares. That there was a way swing of the pendulum that way. But because terms were sort of generally standard and there's the NVCA, which is the industry organization, has standard terms, most people are using those. You don't care as much about them because they aren't affecting you. So I would say with this shift in the economy and things that have gone on, not only have valuations, certainly, especially at the later stages, dropped, but also some of the terms have actually gotten swung back, if that you think of it as a pendulum, to being more investor friendly. So that includes, and maybe we'll get into some of this stuff in more detail, but liquidation preferences or other kinds of terms that you have to also trade off because the economics change depending on the type of exit that's going to happen.